Hello everyone and welcome to this month's special webinar on the Fed with myself, Craig Erlam, Senior Market Analyst here in London. And with me this month is Ed Moya, who is my colleague in New York, Senior Market Analyst over in the US. Ed, say hello.
Hello everyone, Craig. Always fun to do these joint webinars, and I think we're going to have a lot of fun with this one.
We are indeed. How's everything going?
Great. I think markets are, we were expecting it to be a quiet week leading up to the Fed. The Saudi oil field drone attack definitely livened up volatility, and I think we're seeing now markets now just kind of remaining a little bit focused on the Fed, and I think it's going to be a pretty monumental meeting as the great debate will happen. Will it be a dovish or how dovish will this rate cut be? And I think there's strong arguments for both sides.
Absolutely. I mean, I think it was definitely a strong start to the week. Just what everyone wants coming back from the weekend is to start with a 20% move in crude oil prices. Maybe we can touch on that right at the end of the webinar if there is time. But obviously, this is all about the Fed. So, and quite often it's interesting is that the Fed can often take some volatility out of the market earlier in the week, especially when we are expecting a move. And when you get these new economic projections, there does tend to be scope for there to be a little bit more peace and calm, maybe apprehension in the markets. Now, for quite some time, it has seemed inevitable, more so to Ed than myself, that there's going to be another cut at this meeting. And the markets have certainly heavily priced that in. And we were talking just before we kicked off here about how some expectations have changed. It differs from terminal to terminal because they obviously have their own means and ways of calculating the Fed odds ahead of these meetings. But really, for quite some time, it has been 100% priced in. And for those who have visited, who have viewed the previous webinars, I was very much in the camp of we'd see one, maybe two rate cuts this year, and even then I didn't particularly agree with that. I do think a lot of this panic around recessions is a little bit overhyped, and I think the US data in particular just doesn't necessarily warrant action at this moment in time, and it may be better served further down the line if these fears do materialise. But Ed, you've been absolutely convinced for months that we are going to see these three rate cuts this year, and I must say, as things stand, I'd say the smart money's probably backing you.
Well, thank you. And I was taking a whacking at the MarketPulse team meetings. I've been the most dovish analyst on the team.
You're very much the James Bullard of the MarketPulse team.
I am, and I think that we are seeing, the slowdown and just everywhere in the world start to weigh on the U.S. economy. The labor report starting to show some signs that the economy is losing its vigor. But for me, I think my strongest argument, going back a month, was really that the Fed needs to reduce the inversion pressures on the yield curve. And when you have the rest of the world orchestrating policy that is accommodative, you don't want to disrupt that by being, pretty hawkish when you're the largest economy. So I think there's going to be a big focus on how Powell can deliver his message. I think the market is pretty much content that they're going to be a 25 basis point rate cut. But the whole focus is on forward guidance. What are they going to do? There is big uncertainty because right now, even December, it's just, it's almost a coin flip right now for that third critical cut for many. And, if three cuts is a mid-cycle adjustment, great. But if we go beyond three, I think that is going to be to most a switch to the easing cycle. So we're going to see the effects of all the geopolitical risks start to weigh on the Fed's mind. And I think with where the data has been going and the trend has been fairly strong, that we are seeing softness in manufacturing that will trickle down to the U.S. consumer, and we're starting to see weaker points there too. So I think you're going to see that calls for additional rate cuts to remain in place. But I think that if we do get a handful more rate cuts, I'm not in the camp that is targeting U.S. yields to go negative like some of the other major economies out there.
Yeah, I mean, you've touched on a few things here, and we do have some like pre-prepared screens and things like that, which we can cover them in more detail. So, as I mentioned earlier, there's kind of three places where you can typically get your Fed interest rate expectations. There's CME Group, there's Reuters, and there's Bloomberg. And there is disparity between the two current at this moment in time. You can see here, for example, that CME Group has around just over 70% chance of an interest rate cut at a meeting. Just again, for context, even a week ago, this was 100% and then some for a 50 basis point move. If we take a look at the Reuters Fed Watch tool, this is showing a 65% chance of a cut at the next meeting, and a 35% unchanged. And again, this was very much 100% even a week ago. And I must say, when seeing this over the last couple of days, it gave me some hope that I may have a chance of still being right this year. Although then the disparity does create confusion as far as I'm concerned. And I'm very much leaving this to you to explain what this means, because it still doesn't make too much sense to me. But you're saying that Bloomberg is still 100%. It's so I think that highlights the confusion in the markets. But I think it also does highlight there is maybe a couple of reasons why 100% maybe, especially 2 more rate cuts this year, maybe a bit much potentially, because as I said earlier, I think the data is still good. We had the inflation data on Friday, which at the time the markets on Thursday, which at the time the markets did relatively overlook. We had the stronger retail sales figure, and that's actually been on a positive trajectory really over the course of this year, which markets have generally looked through. And I think it was the oil price spike yesterday that really sent expectations a bit haywire. Maybe this idea that higher inflation puts at risk these interest rate hikes. And again, this isn't a story I'm buying, because as far as I'm concerned, if you're seeing oil price hikes, the last thing you need in an economy is rate hikes on top of it, just to pressure the consumer more. I wonder whether there's a culmination of these different things, and the fact that we have seen this kind of limited progress with the trade war between the US and China, with both sides offering these small concessions, the promise of talks in October, and the fact that we have generally seen a little bit more the risk appetite in the markets returning. I was wondering whether this was feeding into the changing expectations on Reuters and CME Group as well. But again, as you say, Bloomberg tells a very different story, which just creates that extra layer of confusion. Maybe not for the meeting tomorrow per se, but for the messaging that traders are expecting at the meeting for signals for the end of the year.
No, well said. And I think the Bloomberg screenshot is highlighting the consensus right now, 93% for a 25 basis point rate cut, and then there is a small camp that are targeting that 50 basis point rate cut. I think you're going to see a lot of the economists right now. They're just even over the last 24 hours, there's been a tremendous amount of volatility in the repo market. So that affects short-term borrowing, lending, credit. If the credit markets are in trouble, then the Fed is going to panic, and you would see, that would warrant negative rates. They would do everything in their power to make sure that they are keeping this expansion going. But if we see credit markets come into concern, then you're gonna see that's a game changer for the Fed, more so than right now than the lingering effects of the trade war. So it is something that you're going to see throughout this Fed meeting. There's going to be the main, the target range is at 25 basis point probably, but there's a lot of economists that are focusing on the IOER, which is the interest rate paid to the banks for deposits that they hold with the Fed. And this is going to be something that we might see some tweaking there. And if we do see the Fed act, I think you're going to, with the IOER, that's going to kind of help cement the dovish expectations that would quite possibly make my counterpart Craig wrong with his call for only a limited amount of cuts here. So I think that there's a when you take a look at how bank lending is going, and you take a look at all the yield curve analysis, it's really starting to drive a lot of this dovish forecasting that you're seeing from a lot of these economists.
Right, so that really brings me to the next point then, because a lot of people are trying to insinuate right now that that Donald Trump is driving this idea that the Fed is finally backing down. I've said for quite a while, I still don't think the Fed's backing down. If anything, I think it's made the Fed more stubborn. I think what the Fed's backing down to is the fact that markets are not giving up the fight. The markets are piling on the pressure, backing the central bank into a corner, and forcing them effectively to cut interest rates because they've already effectively cut interest rates on their behalf. And looking at another slide which you sent over, which is the yield curve, which I will bring up just now. Oh, that's the same one. Why do you think markets have got this idea? Why do you think investors have got this idea that these interest rate cuts are so necessary? Because as far as I'm concerned, and granted, I'm coming to this from the UK where we can only dream about 2.5% growth at this moment in time, and looking at Europe where they can only dream of 2.5% growth as well. 2.5% growth, retail sales which are on an upward trajectory since the start of the year. Housing market is healthy-ish. Unemployment, it is at a multi-decade low. Wages are rising steadily. Why do we need interest rate cuts? Why are people so worried about a recession and therefore deeming it necessary to force the Fed to cut interest rates in this way?
Well, I think there's a couple things. I think there's too much of an emphasis right now that everyone takes a look at what has happened in the past, and while yes, historically, you saw the 3-month, 10-month invert, then the countdown for doom and gloom times and recession concerns, within a year and a half or so. And then when you focus on the spread between the 2-year note and the 10-year, it's been, that's been foolproof. That's never been wrong. When you talk to bankers, they care about the 2-year, 10-year spread, bank lending, and that's why this major reversal that we've seen with that. Now, it was inverted temporarily, but now, we are seeing the 2-year 10s right around that 8.5 basis points live. So it is critical for bank lending. It's critical for if we don't have bank lending in order, that will spell disaster for the economy. That is how the U.S. economy. It's kind of like the engine for keeping this expansion going, or just stable growth. So the whole focus right now is trying to get the yield curve kind of back in order. It's not healthy when the 10-year Treasury is significantly below the Fed funds target rate. And right now, we did see. Everyone was calling for fresh record lows, a test of 132, 1.32% on the 10-year Treasury yield. So that's the bottom chart. And then we saw a wicked reversal where now, we're a lot closer to 2 than we are to those record lows. So I think you're gonna see extreme volatility here. So if the Fed is not dovish enough, we're going to see the bond market try to dictate where rates should try to go. And I think that this is where, if we do get a dovish cut, you still might see some stability in the 10-year Treasury yield. You won't see a complete collapse back kind of towards last month's lows.
So this kind of brings me back to the original point, though, and I'm in no way suggesting I'm more intelligent than the market, because that would be ludicrous. You're talking about millions and millions of people here who participate in the market, but it feels to me like there's an unhealthy obsession with the yield curve inversion. Someone's noticed that people have noticed a trend. Obviously, it doesn't make sense for the 10-year to yield less than a 2-year, so fundamentally that makes sense. But people have noticed a trend with yield curve inversions in these 2 to 10s. Notice that it is has preceded recessions in the past and therefore assumed it will precede recessions again. And while we talk about them like it's something we're observing that the markets have no control over, the reason why they're inverted is because markets have driven them towards that way. So as you alluded to then, if the Fed is in any way hawkish tomorrow, then the markets will punish them and push the 10-year yield lower. They'll move the yield curve back into negative territory, and the recession flags will be flying again. So it does just... It's the part I find most interesting about this. Granted, in 2006, many people didn't see the 2008 Great Recession coming. Back in 1999, a lot of people didn't see the dot-com bubble bursting. These things can spring surprises on us. Obviously, some people did. But it still confuses me why the obsession with recession, given that so much of the data is still very good. It seems to be a very self-inflicted wound in many ways, but I guess that's something we'll have to wait and see how it plays out. Like I say, it's been a reliable recession warning in the past. We'll wait and see if it is now. And obviously the Fed is not going to, as I've just alluded to for myself, the Fed isn't going to be sitting here saying, well, we're actually cleverer than everyone in the markets. The chances are they are going to follow if the market doesn't alleviate any of the pressure on the yield curve. And therefore, like I say, the clever money is very much backing you rather than me at this moment in time. So, I mean, that pretty much brings us to the meeting itself. So we have on our economic calendar here, the meeting takes place tomorrow, Wednesday, September the 18th, it's 6 p.m. GMT, so that's actually 7 p.m. UK time, 2 p.m. if I'm not mistaken, in New York, Ed. So what are you expecting? Obviously, you're expecting an interest rate cut. Markets are expecting an interest rate cut. The Reuters and CME terminals suggest not as guaranteed, but I think, to be honest, I'd be very surprised if we don't see an interest rate cut at this point. And I do think this oil price move has caused distortions in maybe some of the methodology behind those particular metrics. What are you expecting, though, from my perspective, which is ultimately more important, from the projections, from the statement and the dot plot, which will ultimately tell us whether that third rate hike that we've been discussing is actually coming this year?
I think the short answer is I think you're going to see the dot plots solidify another rate cut. I think December will probably be when we get it. I think we will. I think it's a coin flip right now whether we see the IOER cut. So that's the interest rate paid to banks. I also am a little bit. I don't want to say this is going to be Powell's capitulation, where he finally kind of maybe they'll call it an extended mid-cycle adjustment. I don't know, but I think that there has been a big one other topic, inflation. We could dabble with it a little. It's probably worth a separate webinar in itself, but inflation is going to be, I think that the Fed is going to be more concerned about. They've been ineffective in fighting deflation. Other central banks have been ineffective, and despite this record expansion, we've never really had a strong move above their target. And they're going to probably have to revisit how they go about their target. But I think that is going to be something that, even with this oil spike, it's not going to likely have us see that derail the dovish argument. So I'm expecting Powell to be a little bit more dovish than he has been in past meetings. But if he's ambiguous, that's his job. But I think that he will kind of keep the door open for another rate cut, and I think that will possibly be enough to see a little bit of dollar weakness if he does become a little bit more on the dovish side.
I mean, I feel like I'm constantly fighting the corner of the central banks here, not just obviously with yourself, but I mean generally, in that people saying like they've been ineffective in inflation. I've heard that argument quite a bit, but CPI inflation is above 2%. Core CPI inflation, I should say. In the UK, inflation here is at 2%. The euro area, I think, has more fundamental issues, has far more structural challenges. The banking system is extremely weak, and I think there's a vast amount of reform that needs to happen there, which is responsible for the lack of inflation. I think the speed at which we've seen I think technology, for example, has been a deflationary measure. The Fed doesn't have control over this. Neither does the Bank of England, neither does the ECB or others. I always find it like, yes, these central banks, part of their target is inflation, but I don't always think that they're just assuming that keeping interest rates low for longer is necessarily going to deliver it. And case in point with that is Japan. They've had interest rates low for 2 decades. They've had bond buying for most of the last decade, and they still can't deliver inflation. Is that the central bank's fault, or does it highlight more structural issues that is actually keeping inflation low? I feel like if we are now a decade on from the crisis, and more than a decade on from the crisis, and I was very much supportive of the Fed raising interest rates over the past few years, because I do feel like when the next downturn arrives, I'm not sure how effective quantitative easing is in delivering in the same way that interest rate cuts do. And I do just feel that a prolonged period, years and years and years of low interest rates, almost fuels many of the issues with regards to low inflation, as much as raising interest rates, if not more than raising interest rates. Because effectively, if you're keeping interest rates extremely low for years and years and years, you're also effectively supporting these zombie companies who are effectively stopping an economy becoming more productive. You're allowing these major tech companies to develop this tech at an extraordinary rate, because they can just keep raising debt and raising debt and raising debt, making losses and losses and losses, and again, keeping inflation low. So I almost feel like one thing that needs to come out of this last decade or so is there needs to be a kind of rethink about what a central bank's mandate really is, and what more can be done to support them, because I feel right now too much is expected of many of these central banks. And for that reason, like I say, I've very much been supportive of the Fed raising interest rates throughout this period, and I think they are now in the strongest position as a result. And I'm like I say, not necessarily convinced by the cutting of interest rates right now, but what do I know? Let's, I think, move on to some charts and see what they're telling us. We'll start with the euro dollar. Obviously, it's the most traded currency pair, so that makes a lot of sense. I mean, it's continuing to look weak. It was starting to lose momentum for a while. It's maybe started to lose a little bit of momentum more recently into that 111. Kind of got that 109.50, 109.40 area support, 111. The kind of peak, almost like a bit of a double bottom forming. But then the dollar just remains strong. It seems that the dollar can't be beaten, and no matter how many times people seem to call a high on the dollar, it finds its way to at least sustain those highs, if not break a little bit higher. I think as much as anyone, would love to see a break of that 112, 113 range. I'd love to see us propel higher. I think it would make these charts far more interesting rather than this very slow grind lower. But I'm just not particularly confident that the euro or the dollar has the ability to sustain such a move. What do you think, Ed?
I think I'm going to highlight one of the chart patterns that I identified in my pattern recognition webinar. And if you kind of zoom out a little bit longer, right now you could see. So that's perfect. So right now you can see that big rally that where we went from roughly, let's just say the 104 region all the way back to the 125 region. That would be our X to A move, and right now tentatively, then we had a major swing down. Then we had kind of in the middle of the 2018 summer, we had a little a rally there that would tentatively be right there exactly, would be our B to C rally. And tentatively right now it is forming a potential bullish Gartley pattern. This particular pattern has survived the ECB event, and if valid, this pattern could call for major retracement here, targeting possibly 112.50. If invalidated, then as you could see, there's plenty of room to go. So these patterns, sometimes they're right, sometimes they're wrong, but when they are right, at times you'll see some strong reversals. This one would be a staggered one, because typically you like the pattern to be rather immediate, not taking as long as this one has been developing. But so far, the key support levels have held. So if we see fresh recent lows, then the pattern could be invalidated.
Cool. Right. Cable, there's a lot going on here in the UK as well. I don't think this is really the platform for Brexit chat. We'll save that for another special webinar very soon. But we have obviously seen the pound performing quite well recently, even though the dollar to an extent has as well. We've kind of hit these kind of 125 levels. This looks like a big area of potential resistance for me. We had the breakout of the channel, which was really interesting, given that a lot of the momentum was against the pound at that time. But the recent low that we had really had no support from momentum side. So when we broke through the top of this channel, then we have really just propelled higher. I'm still skeptical about how much more upside we can possibly see on this ahead of a potential no-deal Brexit. But what I find interesting is you've kind of got this double bottom setup. So that's based on the textbooks, of course. This would suggest that there's potentially still a bit of room to run into these kind of 126s, which isn't too much further, to be fair. But I still think the downside pressure is going to remain on this pair. I still think the downside pressure as we get closer to no deal will remain with the pound, especially if Boris Johnson starts to challenge the courts and believes he can deliver no deal, which is something that the markets are effectively betting against right now. But also just the dollar, right? It's just the dollar strength. What's your thoughts, man?
Pretty much on sterling right now. For me, it's stay away. There's just too much volatility right now with the no one knows how Brexit's going to unfold, and right now I see 125.50 as initial as major resistance for me right here. I think that you're going to have the the momentum trades be with thin volumes. I don't think you're going to see heavy positioning right now. So right now, for me, pound dollar is just one of those that you're going to see it trade heavily on the news, and you might.
And we're not short of news.
Yes, and it seems like every day there's a fresh Brexit headline.
Yeah, I mean, I think this entire fib range, really, this entire retracement range, 125 through 128, just looks absolutely cluttered with resistance. So yeah, again, very news driven and certainly one to watch. Let's look at gold. I'm aware of the fact that we are running over time, so let's have a look at gold and maybe we'll wrap things up. And I mean, gold's looking vulnerable, man. I really think this kind of 1480 looks extremely vulnerable. We've run into a lot of resistance around this 1550 on numerous occasions, 1560. And just to highlight, last time we were trading around these levels, 2013 through 2016, again, this was a major area of support and resistance during this time. So the fact that we started to see it approach these levels on lagging momentum didn't come as a great shock to me. And it seems that finally gave way earlier this month, a couple of weeks ago, and then we've had that 1480 test. What really surprised me was yesterday we had the oil price shock, we had that risk aversion, that move to risk aversion. Gold initially did benefit, we pulled back from those highs, and we've just not really been able to sustain any serious kinds of move. And I really wouldn't be surprised if the Fed's just not as dovish tomorrow as the markets want them to be. And as you say, if the market punishes the Fed, then if the Fed is more hawkish and doesn't deliver the kind of reassurance that the market wants, which is another rate cut this year, then I think that 1480 could come under some threat. Whereas if the Fed surprises and delivers, then maybe that provides that support. But what we've effectively got in the meantime is a potential head and shoulders pattern forming with the shoulder here around 1525, the head up around 1560, and that 1480 is key support for me.
I agree with a lot of that. I think that you're going to see this be one of the cleaner reactions to the Fed. So 1480 is the line in the sand for me as well. And I think that once you have everyone seeing the PBOC clear signals, massive stimulus, ECB kind of a whimper of QE, but with Lagarde coming in, there's growing optimism. You'll see maybe more fiscal policy. So you have a lot of the world, with the exception of the Norges Bank, looking to deliver a lot of stimulus here, and you need the largest economy to be on board. So I still think that we're going to see more accommodation, but if the Fed doesn't deliver that message, then yeah, good luck holding a bullish position. So yeah, that will be a definite big mover tomorrow.
All right, I mean, let's wrap things up there. If you want to follow myself and my colleagues, then please do check us out on Twitter. You can see my Twitter handle there, Craig_Forex. Ed is EDJ Moya. Then you can also follow Alfonso, who's in Toronto. That's at Alfonso Esparza. We have Andrew Robinson in Singapore, Andrew R_Forex, and of course, Jeff Halley, the voice, although I think that Twitter username was taken. But you can follow us all on Twitter. You'll also find recordings of this webinar on Twitter. If you're watching this webinar on YouTube, then please don't forget to like and subscribe and leave any feedback in the comments box below. But like I say, check out all our content, follow everything we're putting out, check out the podcast, OANDA Market Insights, and most importantly, check out OANDA Market Pulse on marketpulse.com. It's where you'll find all of our content, and it's where you'll find a copy of this recording. Thank you very much.